Well, I spent a lifetime looking for you. Single bars and good time lovers.
Okay, in this series of videos, we're going to take a look at financial statements. We're going to start off by taking a look at the balance sheet. So let's jump in. There are a variety of financial reports that we care about and we're going to be considering in this course. And there's a few different sources that you can use to find those annual reports, 10Ks and 10Qs. So we're going to be looking at probably a few of these over the course of the semester, but Zax.com, finance.yahoo.com, finance.google.com are all useful sources, pretty easy to get to. Also, the company websites are going to usually have a repository of financial statements in their kind of investor relations section. And then lastly, this is a very good one to use, sec.gov. They have all the filings from companies, and you can take a look at those. In fact, I may just jump to sec.gov real quick and see what that looks like. So if you go to sec.gov, you can go in here and look under filings, and we're going to, actually I'm going to go up here and do company filings. Then you would just click the ticker symbol or the name of the company. Let's look at Apple for a second, AAPL. So we're going to click on that. And this has every filing that they have made with the SEC. So 8K, 424B2s, all sorts of filings. The things we're going to be paying the most attention to are 10Qs and 10Ks. And so we can search for the 10Ks by typing in 10-K here. And it's going to just show us all of the 10K filings, and this is an amended 10K filing that Apple has done over the years. So it's a very handy tool. This is the actual filings. A lot of the other sites, Zax, finance.yahoo.com, finance.google.com, they've kind of taken this raw information and then aggregated it, sliced it, and diced it in the ways that they do. So this is kind of from the horse's mouth here when you go to the SEC website. And this is probably the best site for you to use for any of the reports or projects that we use for the class. And let me just finish off the tour here by clicking on this most recent 10K. So I'd click on the documents, go up here to this first one, the 10K, and click on this little HTM link. And I got my 10K. If I scroll down, I see these hyperlinks here. I can get to the various parts of the 10K. The thing is we're going to be looking at most often, I think, although all of this stuff is potentially relevant. Section 6 or Item 6 is selected financial data, so it's kind of cursory information. And then Item 8, and this is usually across all 10K companies. All 10Ks have this same kind of structure. Item 8 is going to be financial statements. So if we click there, we're going to be shot to the financial statements. So that's a quick way to use some of the tools, and particularly the sec.gov website, to find financial information. So the four financial statements that we're going to look at are the balance sheet, income statement, the statement of cash flows, and the statement of stockholders' equity. We'll be looking at all of these over the next few videos, next few modules. So let's move on here and take a look at the particulars of the balance sheet. So a balance sheet is simply a snapshot of a company's assets, and another way to think of those assets are the company's investments. And we also see the company's financing decisions, so that's going to be the liabilities and equity portion. And all of this is as of a particular point in time. So it's a snapshot at a point in time. So this might be quarterly, it could be annually, depending on which report we're looking at. A few different important notes about how the balance sheet is organized. Assets are listed in order of liquidity. That is to say how long it's going to take to convert those items into cash. So cash will be the very highest thing on the balance sheet in the asset section. It's a current asset. It's going to turn into cash within a year. And it's already cash, so it's the most liquid of the assets. And then they'll kind of go down in order of liquidity. Liabilities are listed in order of when they must be paid. So the current liabilities all must be paid within the next year. And then the long-term liabilities have a life that's longer than that. Equity is the residual. That means it's the leftover. So whatever is the difference between assets and liabilities is going to be the equity. And then finally, changes in the balance sheet from year to year or quarter to quarter are reflecting the different investing and financing decisions that the company is making. So that's what where things flow into the financial statements. It's going to show up in the balance sheet. So let's look at assets a little bit more closely here. Current assets, the one, as I mentioned, that can be converted into cash within 1 year. That's the definition of a current asset. So examples would be cash, marketable securities, and these are ones that are very liquid. They're easy to sell. It wouldn't take a long time to sell these things for very close to their market value. Receivables, accounts receivable is another way of talking about those. These are arising from sales that a company has made, not on a cash basis, but they've basically taken an IOU, and when they receive money for that later on, it's converted into cash. So receivables could have lives of 2 weeks, 30 days, all the way up to 6 months or more. So the main idea here is that a receivable is going to be converted into cash within 1 year. And then finally, inventory is items that you have, a company has, and the notion is that these are going to be sold and turned into cash within a year. Now we're going to perhaps talk a little bit more about inventory policies later on, but it's important to note that there is some discretion in the accounting world how you account for inventory. And the two big accounting methods for inventory are LIFO and FIFO. That stands for last in, first out, and first in, first out. And which one of these you use, which one of these a company uses, has implications both for its balance sheet, what the book value of the inventory is, and also the income statement. We'll perhaps look at that in more detail later on. The next thing on the asset side of things is fixed assets. These are the ones that are going to be around for longer than a year. And the typical fixed assets are going to be PP&E, property, plant, and equipment. And that's going to be always shown net of depreciation. Perhaps it may show the gross value and then the accumulated depreciation, all the depreciation that's happened since the assets were purchased. But we're going to be concerned with the net amount. And then things like tangible or intangible assets will show up there. So items like trademarks or patents, and then goodwill is a kind of a common item that'll show up, especially if the firm is involved in many acquisitions. Liabilities, again, we're going to bifurcate those into current liabilities and long-term liabilities. Current liabilities are ones that are paid within a year. So things like accounts payable, this is when you buy something on credit. You're going to usually pay that very soon, definitely within a year. Notes payable, and this is an important distinction. This is a loan, a kind of a financial arrangement that you've made. You're going to be signing a loan agreement, a contract, and the kind of the defining characteristic here is that this must be paid back within a year. Otherwise, it would be considered a long-term debt. Accruals, so things like wages, taxes, or rent that you haven't paid, that you've kind of incurred the expense but you haven't paid as of the close of the accounting period, are going to show up in accruals. So if you pay wages weekly, bi-weekly, or monthly, and your accounting period kind of stops in the middle of one of those pay cycles, you haven't paid the workers, but you owe them, and so that would become an accrual. And then finally, the current portion of long-term debt, that's the amount of any long-term outstanding debt, any bonds, loans, that sort of thing, that perhaps have multiple years, but there's a portion of that long-term debt, that bond, that is payable within the next 12 months. That's going to show up in the current liabilities. So the long-term liabilities, again, these are ones that are going to be paid later than 1 year from now. So long-term debt, and then deferred taxes is also a common long-term liability. Equity, as I mentioned, is the residual claim on the assets. It's the leftover. So equity is defined as the assets minus the liabilities. Typically, that's going to be common equity, also known as common stock. And this is what people normally think of. When you own stock in a firm, you're going to have an equity ownership, an equity claim on that firm. There's also preferred equity, and this is kind of a hybrid instrument. It's senior to common stock in the sense that it has to be paid first. The dividends that go to preferred shareholders have to be paid before common stockholders receive their dividends. But preferred equity is junior to debt or other liabilities. That means you got to pay off all your debts first before preferred equity holders can be repaid. Another important piece of equity is retained earnings. And this is defined as basically the cumulative amount of earnings that have not been paid out as dividends over time. And as we look at this last little piece here, an important note, equity is typically going to grow for a successful firm, not because their stock price is growing, that doesn't really show up in a balance sheet. It doesn't show up in the assets or the liabilities or even the equity portion. The value of common stock is kind of divorced from the financial statements. The reason that equity will grow for a successful firm is because retained earnings is increasing. That is, the firm is making money over time, and if they're keeping that, reinvesting in the business, then the total equity will grow over time. I'm going to go ahead and stop here, and we're going to pick up with the last few slides, the last couple of slides in the next video. I don't want these videos to go too long, so I'm going to stop here, and we'll pick up with this slide in video number 2.
You came knocking, my heart